Hi, this is Stuart Weems and welcome to the next instalment in this fundamental series. I've recorded 5 videos to share and talk about some really fundamental financial planning topics and try to explain them in very sort of simple terms. In this episode and this video, I want to show you how to invest in the share market using an evidence-based approach, which means that you've got a much greater probability of producing good long-term returns than trying to sort of pick stocks or take any other sort of approach, and really to demystify to a large extent investing in the share market. Of course, all the information in this video is general advice only. You need to make sure that whatever I'm talking about in the video is appropriate for your circumstances. And if there's any doubt regarding to that, certainly worthwhile investing in getting some personalised advice. Okay, let's kick off by talking about some of the advantages of investing in shares. Now, I've got to say right from the outset, I love to invest in both property and shares, and I have been investing in both property and shares for a very long period of time. So it's not about which is better. Each will have their pros and cons, and it really depends on your stage of life. That will determine, and whether you want to borrow to invest, most importantly, which will determine whether you should be investing in property or shares. And I believe that most people, if not all, probably will benefit from holding investments in both of those major key asset classes. But with respect to shares, there are some advantages. Firstly, it's very hands-off. When you have a property, you've got a tenant, and sometimes that tenant has some requests or property needs maintenance or these sorts of things. It can take up a little bit of time, whereas share investing virtually takes up no time. Secondly, you can get a higher level of income net of expenses from a share portfolio. Now, it depends on how you invest and what you invest in within that portfolio. But for example, if you buy the ASX index, the Australian Share Index, you can expect around 4.5% in terms of income. That's the sort of dividends and so forth. Probably higher if you include imputation credits, which are the tax credits that you get from investing in shares. Whereas if you're investing in property, whilst you might receive a decent income, there's a lot of expenses associated with property. And so shares do produce a more predictable level of income. Liquidity is very strong. That means that if you ever need to access your capital or sell down investments or anything like that, there's 2 benefits. Firstly, it's very liquid. You can sell it today. In 3 days' time, the money will be in your bank account once those trades settle. And secondly, you can sell incrementally. So you can sell 5% of your holdings or 1% of your holdings, whereas you can't do that with property, obviously. And so therefore, it's very flexible. It's flexible in terms of how much you're investing on a regular basis, or if you're investing on a regular basis, whether you reinvest the income from your portfolio or spend it. It's very flexible from that perspective. Again, if you're investing in property, it's a lot less flexible. Now, there's pros and cons with that, of course. One of the benefits of investing in property is you are locked in to investing a certain amount each month, the cash flow holding cost. And so it takes that decision out of the investor's hands and forces them to pursue that long-term strategy. Sometimes that flexibility is a negative, because maybe you will switch off investing, if you become concerned with the market and so forth. And finally, it's very low cost. It doesn't cost you very much to invest. And I'm going to show you this approach, which is very cheap and that anyone can implement regardless of their skill or knowledge of the share market. Some negatives associated with investing in shares. Obviously, it's a lot more volatile than property. It has twice the level of volatility, which means from year to year, your returns can really range 2/3 of the time between losing 10% and making 30%. So it's a really wide range. Whereas with property, 2/3 of the time, your returns are either going to be 0 or positive 20. You don't have those negative returns, or less likely to have those negative returns in property. And lastly, gearing. It's a lot easier to borrow to invest in property, a little bit more difficult to do that, and sometimes more costly to do that when investing in shares. Okay, there's 3 broad ways you can invest in the share market. You can obviously go and pick direct stocks. So you might say, look, I'm going to go and buy some CBA shares and ANZ shares and BHP and so forth. And you can work out, and you might throw in some speculative shares in there, and you've got to work out which shares to invest in. You've got to work out when to buy those shares and when to sell, potentially, if they're not going to perform. And then once you've done that, you've got to work out, okay, where do I reinvest those monies? So there's a few decisions there with respect to direct share investing. The next option is to use what they call active management. So you go and pay a fund manager, or you invest in a managed fund, and that fund manager makes all those decisions about which stocks to buy, when to buy them, when to sell them, how long to hold them for, etc., etc. And what they're trying to do is beat the market. They're trying to produce better returns by doing that. The third option, which is the option that is by far the best option, it's called passive investing or rules-based investing or index investing. There's a few different terms that people use, but it's really the same sort of approach, which is using a rules-based approach to get a very diversified exposure to a particular market. And so that could include buying an index. So for example, there's the ASX 200 index, which is the top 200 companies listed in Australia by value. And so the 200 most valuable companies. And so a ASX 200 index fund will go and buy invest in each of those 200 companies in proportion to its value compared to the index as a whole. So, for example, if CBA, its value represents 8% of the total value of the index, 8% of your money goes into CBA and so forth. That's index investing, and it's by and far the best way to invest in the share market. But you don't have to take my word for it. You can look at all the data. So this is the data over the last 15 years for Australia. It shows that 83.57% of active fund managers have failed to beat the ASX 200 index. So really only 16% have outperformed. But it's not the same 16%, because outperformance doesn't persist, which means that you can have one fund manager that beats the market for 1 year. 40% will remain in that top quartile for the second year. Only 5% for the third year. So what it means is that whilst this data shows us that 16%, just over 16% of active fund managers have beaten the market, it's not the same 16%, which means that if you want to invest in an active fund manager, you've got to really work out which fund manager is going to beat the market over the next 12 months to 2 years. And then, because only 5% will remain in the top quartile of performance for the third consecutive year, what you've actually got to do is sell all those fund managers over the next 1 to 2 years and then work out which ones are going to be the better performers going forward, which is pretty crazy. And obviously, you know, you're on a hiding to nothing to be able to do that. This is the Australian data. In the US, 93% over the same period have failed to beat the index. In Europe, 89%. So the data is sort of around 20% or less of active fund managers can beat the market over the long run. Of course, it's not the same 20%. Now, this data is published on and updated on the website, the S&P Dow Jones Index website. And I'll put a link in the description into this video so you can check out that data yourself over different time periods. Essentially what it means is that investing in direct shares or active management is like trying to find a needle in the haystack. And the analogy is just invest in the haystack, which is the index. Invest in the index, then you don't need to worry about which shares to buy and which shares to sell or which active fund manager to pay. And they're very expensive. They tend to charge around about 1% per annum to manage your money, whereas you can buy an index fund for a 20th of that cost or even lower. And I'll show you how to do that. I'll show you which sort of index funds to look at. So really the advantages of indexing, well, firstly, it's backed by an overwhelming body of evidence that demonstrates that if you employ this rules-based approach, you're more likely to achieve better outcomes longer term. You don't need any skill. Anyone can invest in an index fund. You really don't need to know anything about the share market. It's very low cost. It's very diversified. and really simple to implement. So there's really no negatives associated with, investing in index shares. Better returns, lower fees, and really simple. So there's different diversified ETF. ETF is an acronym which stands for exchange traded funds. And so there's so an exchange traded fund is really just like a managed fund, but it's just a listed stock. So it's listed on the ASX, which means that if you can open up an online share trading account and you can buy shares in VDGR or one of the different index funds that I'm going to talk about here, then you've got automatic exposure to lots of different asset classes like bonds, Australian shares, international shares, smaller companies, emerging markets, everything that you as an investor and me as an advisor should say you would want to have exposure to, that you should be investing in, but you don't need to make any of the decisions. And the managers, the index managers like iShares, Vanguard and BetaShares will make all the decisions for you. And so iShares, which is a company called BlackRock, it's the largest fund manager in the world. Vanguard is the second largest fund manager in the world, and BetaShares is an Australian fund manager. And so these companies stood the test of time, and they're very popular for good reason, because their products are really worthwhile. So in the link, I'll put a link in the description to the ASX website that has a full list of all diversified products there. So there's some new ones by iShares. The Vanguard ones have been around for a very long time. And the BetaShares ones have also been around for a pretty long time as well. They're all very good. There are some small differences between the products, but they're not really that material. It's really about picking, do you want balanced growth or high growth, and then making an investment in those products. And you can do that, as I said, simply by establishing an account with a online share broker like CommSec or something like that. And if you can just even Google investing in ETFs, and there's heaps of stuff on the web that shows you step by step how to go about buying a share of that ETF. And all you need to do is do that on a regular basis, I would say, if it's appropriate for your cash flow. So maybe you might be investing $1,000 a month. Do that and just do it religiously, the same day every month. Don't try and time the market or pick the market. All the evidence shows that's not important. Just invest $1,000 a month and then just don't even look at it. Shut your eyes, and in 10, 20 years, you'll wake up and the returns will be extraordinary. So if you'd like to learn more, there's again a link in the description to subscribe to my blog. I produce a blog every week. So if you're interested in learning more about investing, certainly check that out. And I hope this video has been really worthwhile. Cheers.